Some investors make the assumption that rising rates are bad for high yield, but history has shown us the opposite is true. Short-term volatility in rates can cause fluctuations in prices of fixed income assets. However, steadily rising rates are not the greatest risk to the high-yield asset class. In fact, rising interest rates are generally a function of an improving economy. As the economy improves, most companies benefit from increasing earnings and cash flow, which allows them to better service their debt. Improvements in debt service lead to lower default risk, which in turn results in positive credit re-rating and tighter credit spreads for the bonds of many companies. In short, interest rate risk is real, but credit is a tremendously important aspect of the asset class, and one that may serve as a natural hedge during periods of steadily rising interest rates.
First, we don't believe we are in a bubble. Yes, the summer of 2014 looked a lot like the summer of 2013 in terms of the spread widening we experienced. And we would agree that valuations are stretched in lower quality issuers in the high yield market. But that is partly a function of the overall low rate environment we have been in. As we look out into 2015, we anticipate the Fed will start to raise interest rates by the middle of the year. This doesn't make us cautious on credit overall, but it does make us more cautious on lower tier or riskier credits that are very dependent upon access to the capital markets. Reducing exposure to the riskiest high-yield credits in this type of environment is a good example of how an active manager can modulate risk in conjunction with doing the fundamental research that is essential for successful investing in the high-yield market.
Understanding the supply of new bond issuance is important for high-yield investors. We actively track the expected size and underlying quality of new issues coming to market to help gauge overall risk behavior of corporations. For example, in recent years, proceeds from the majority of new issues has been used to refinance older, higher interest rate debt. In our opinion, this type of issuance is healthy compared to an issuance used to fund stock buybacks or to pay large dividends to shareholders. When companies do get more aggressive with financing strategies, it may mean it's a time for us to adjust how we think about the overall market and portfolio positioning. Tracking this type of information may help detect those shifts in companies' behavior before other market participants, which can be very valuable to investors.
The backdrop for credit remains quite healthy today. In the second quarter of 2014, we saw the average high-yield company deliver high single-digit sales and EBITDA growth. In addition, debt levels remain relatively unchanged as the refinancing cycle continues to play out. There is some risk-taking returning to the market as companies borrow to expand their businesses organically and through mergers and acquisitions. We monitor this quite closely. Through the summer of 2014, most M&A activity has been driven by strategic buyers, meaning one company buying another company in the same industry. This contrasts with the pre-crisis deals in which financial buyers, namely private equity, played a major role. That's relevant to investors because deals have been structured much more conservatively than what we saw pre-crisis, which is at least partially a result of the type of deal participants. Considerably more equity has been used as part of recent M&A transactions, which makes the debt issued in those deals relatively less risky for investors.